Hey, wealth-wise family. What is up? So, the latest job market numbers just dropped, and let me tell you, it's like a Hollywood thriller over at the Federal Reserve. They're on edge, folks, but here's the plot twist, it might not be for the reasons splashed across every financial headline. Stick around, because we're going to unpack this, see what it means for your wallet, and figure out how to play it smart in this crazy 2025 economy. Alright, picture this, about a week ago, we got the first of two crucial job reports. This one was from ADP, the big payroll guys. And boom! They said the US economy added way fewer jobs than anyone expected. Suddenly, everyone hit the panic button. Investors got jittery, Wall Street looked like it had seen a ghost, even the White House was breaking a sweat. The narrative? The job market's cracking, the economy's stalling, maybe the Fed needs to step in and hit the stimulus gas pedal, right? But then, hold your horses. Just a few days later, last Friday, the official Labor Department report lands. And guess what? It's a total 180. They're saying the US economy added a ton more jobs in May than predicted. Suddenly, the seesaw flips. Maybe the job market is strong. Maybe the economy's booming. Crisis averted. So, what gives? Two reports, two totally different stories. It's like a choose-your-own-adventure book for economists. And this, my friends, is why the Fed is probably reaching for the extra-strength coffee. Because their job just got a whole lot more complicated. Now, why should you, a savvy individual trying to grow your wealth, care about this bureaucratic tug-of-war? Simple. Interest rates. You see, the Federal Reserve, America's central bank, has two main jobs: keep prices stable, that means fighting inflation, and aim for maximum employment. Their main tool. Interest rates. Cut interest rates, makes borrowing cheaper. Think lower mortgage rates, cheaper car loans. This encourages spending, stimulates the economy, and boosts the job market. Raise interest rates, makes borrowing more expensive. This cools down spending, helps fight inflation, but can slow the economy. Here in 2025, we're in a peculiar spot. Remember 2024. The Fed tentatively dipped its toes in the water and cut rates by a single percentage point. But since then? Crickets. Zero rate cuts in 2025 so far. Why? Because inflation has been stickier than a toddler with a lollipop. Now, add political pressure to the mix. Let's say, hypothetically, President Trump, or any administration, really, is loudly calling for lower rates. They'll argue, lower rates mean a booming economy. If mortgage rates drop to, say, 4%, imagine the refinancing frenzy, the new home buyers. That's cash flooding the economy. The Fed's counterargument? Hold on, if we pump too much money into the system while inflation is still a concern, and we've got these pesky tariffs making imported goods more expensive, we could unleash an inflation monster we can't control. Remember, tariffs are essentially taxes on imported goods. If stuff from overseas costs more, prices for you and me go up. That's inflation. This is the crux of the Fed's dilemma, the secret worry that's not just about jobs. It's about this dangerous cocktail of conflicting signals. On one hand, if those initial weak job numbers, like the ADP report, were the real canary in the coal mine, and the economy is slowing down significantly, the Fed might be forced to cut rates to prevent a recession. But on the other hand, if the stronger job numbers, like the Labor Department report, are accurate, and the economy is still humming along, cutting rates could be like pouring gasoline on the inflation fire, especially with tariffs in play. One Fed president was quoted recently saying something like, and I'm paraphrasing here, tariffs will likely push up prices. How much? We're not sure. When will we know? Not for a while. That's central bank speak for, we're flying a bit blind here, folks, and we don't want to make a bad situation worse. And then you get responses from the political sphere, like President Trump, again, hypothetically, tweeting, if tariffs cause inflation, just raise rates to counter it. Simple. Well, it's not quite that simple when you're trying to land a $20 trillion economy softly. Now, what happens in Vegas? I mean, Washington. Doesn't stay in Washington. The Fed's decisions have massive global ripples. The mighty dollar, if the Fed keeps rates relatively high while other major economies, think Europe, which has been on a rate-cutting spree, are lowering theirs, the US dollar tends to get stronger. Good for American tourists going abroad, maybe. Bad for US exporters whose goods become more expensive for the rest of the world. It also puts a squeeze on emerging markets that have a lot of dollar-denominated debt. Capital flight or flood, money chases yield. If US interest rates are attractive, global capital flows into US assets. This can be great for US markets but can destabilize smaller economies if capital suddenly rushes out from their markets. Global growth engine, or breaks. The US is still a huge engine for global economic growth. If the US economy sneezes, the world catches a cold. A US recession would drag down global demand. Conversely, a smartly managed US economy can lift others. Trade wars and supply chains. Tariffs aren't just a US issue. They spark retaliatory tariffs, disrupt global supply chains, and create uncertainty for businesses worldwide. This can lead to what some call slowbalization, a slowdown in global economic integration. So, the Fed isn't just making decisions for Main Street, USA, they're indirectly influencing markets from Tokyo to Frankfurt. Okay, so the Fed's in a pickle, the global economy is a tangled web, and politicians are, well, being politicians. What does this mean for you, the intelligent, forward-thinking investor, a member of our wealth-wise community? This is where we cut through the noise. Investors are currently betting that the Fed will likely not cut rates at their next big meeting, say, in June. Maybe September, maybe later. Wall Street is basically saying, too much uncertainty, too much inflation risk from tariffs. But here's the timeless truth, our economy runs on spending. Lower interest rates generally mean more borrowing, more spending, which can stimulate the stock market, housing, and the broader economy. The Fed will eventually cut rates. The question is why? Scenario A, the soft landing. Enough time passes, inflation cools, the economy stabilizes, and the Fed feels comfortable giving the economy a gentle boost. Scenario B, the hard landing. A recession hits. The economy slows dramatically, jobs are lost, and the Fed has to cut rates aggressively to try and jumpstart things. Nobody, and I mean nobody, has a crystal ball that can perfectly predict which scenario will play out, or when. Not me, not the talking heads on TV, not even Jerome Powell himself. Trying to time the market based on these macro guesses? That's not investing, that's gambling. And we at WealthWise are about building sustainable wealth, not rolling the dice. So, what's your WealthWise game plan? Stay the course with a long-term strategy. Remember, historically, markets go up over the long term. Yes, there will be recessions. Yes, there will be market crashes. They are a natural part of the economic cycle. Think 2000, 2008, 2020. Scary? Absolutely. End of the world? Nope. Opportunities? You betcha. Accumulate assets. Your job is to consistently buy good quality assets. This means budgeting. You can't invest what you don't have. Be smart with your spending so you always have capital to deploy. Consistent investing, dollar cost averaging whether the market is up, down, or sideways, keep investing a set amount regularly. This smooths out your purchase price over time. See downturns as discounts, when the market panics and prices drop, and it will happen, we don't know when, but it will. That's your Black Friday sale for quality stocks, ETFs, or other assets you've researched. This is when fortunes are made, buying when others are fearful. Know your investments. Active versus passive. some of you love digging into company reports, analyzing trends, and picking individual stocks. Fantastic. Maybe you even use a premium research service that helps identify opportunities. Others prefer a simpler approach, broad market ETFs like those tracking the S&P 500 or the total stock market. That's a fantastic, proven strategy too. The key is to have a strategy you understand and can stick with. Filter out the noise. There's so much political drama, emotional headlines, and daily market chatter. The Trump versus Elon Musk Twitter feud that tanked Tesla stock for a hot minute, only for it to bounce back. Pure noise for long-term investors. Whether you're red, blue, or purple, money is still green. Focus on fundamentals, not fleeting fancies. Look, the economic landscape will always have its challenges, its uncertainties, its moments that make even the Fed nervous. Right now, there's a lot of craziness, especially in the political sphere, and people are trading emotionally based on that. Don't be one of them. Your path to financial freedom isn't about perfectly predicting the Fed's next move or the outcome of tariff negotiations. It's about building a robust financial foundation, having a sound investment strategy, and executing it consistently, with discipline, regardless of the daily drama. It starts with a mindset shift. I will control what I can control, my saving, my learning, my consistent investing, and I will not let external chaos derail my long-term goals. You've got this. We're here to help you navigate it. If you found this breakdown helpful and want more insights to build your wealth wisely, do me a favor, smash that like button, hit subscribe, and ring that notification bell so you don't miss our next deep dive. Have questions or your own take on the Fed's dilemma? Drop them in the comments below. I love hearing from you. Until next time, stay informed, stay invested, and stay wealth wise.